Just a few days ago, something unusual started happening inside the global silver market. Large amounts of silver worth billions of dollars began disappearing from major exchange vaults. Not stolen and not lost. Simply withdrawn and quietly moved out of the system. Almost immediately, banks and traders started asking the same question. Where is all the silver going? Because if too much of it leaves the system at once, the entire supply chain could face a serious shock. That possibility is exactly what has analysts watching the market closely. Imagine waking up tomorrow and hearing that one of the most important industrial metals in the world is suddenly harder to find. Not next year, not in a decade, but right now. That is the situation some analysts believe may already be forming behind the scenes. And if the signals are real, the silver market could be heading toward one of the biggest supply squeezes in modern history. Before we dig deeper, if you enjoy calm and clear breakdowns of global financial stories like this, take a quick second to like the video and consider subscribing because it helps the channel grow. Your support allows Iron Ledger to keep bringing you these deep dives. Most people never see the hidden mechanics behind markets like this. Now let's start with the event that triggered the concern. Over recent months, reports began showing unusually large withdrawals of physical silver from major trading vaults. These vaults are where exchanges store metal that backs many paper contracts traded every day. Normally, silver flows in and out of these vaults at a steady pace. But when analysts looked at the latest numbers, something didn't look normal anymore. Billions of dollars worth of silver had quietly left the system. When metal moves out of these vaults, it usually means one of two things. Either industrial buyers are securing supply for manufacturing, or large investors are choosing to hold the metal privately. Both scenarios can signal the same thing. People want real silver, not just paper contracts. And that difference between paper and physical metal is where the story becomes more complicated. Most people assume the silver price reflects real supply and demand. But in reality, a huge portion of trading happens through futures markets. These markets allow traders to buy and sell contracts representing silver stored somewhere else. In many cases, the actual metal never moves. Traders simply settle contracts financially instead of taking delivery. This system works smoothly most of the time, but it creates a strange situation where paper silver trading can be many times larger than the physical metal available. Imagine a warehouse holding 100 silver bars. Now imagine traders buying and selling contracts representing 1,000 bars. As long as nobody demands the real metal, the system keeps running normally. But if too many participants suddenly want physical silver, the imbalance becomes obvious very quickly. That is exactly why recent withdrawals have caught the attention of banks and analysts. Because the safety cushion inside the vault system begins shrinking. If large amounts of silver keep leaving the vaults, confidence in the futures market can weaken. And confidence is one of the most important elements keeping markets stable. Now let's look at the bigger picture behind these withdrawals. Demand for silver has been rising steadily for years. Most people don't realize how important this metal has become in modern industry. Silver is one of the best electrical conductors known to science. That makes it essential for electronics and high-performance technology. Smartphones contain it, and medical equipment depends on it. High-performance batteries also rely on silver components. Satellites and advanced electronics use it as well. Perhaps most importantly, solar panels depend heavily on silver. The metal helps convert sunlight into electricity efficiently. As the world pushes toward renewable energy, solar installations are growing rapidly. This growth is happening across the United States, Europe, and Asia. Every new solar panel requires a small amount of silver. On its own, that amount seems tiny. But when millions of panels are produced each year, the total demand becomes enormous. That demand quietly absorbs large quantities of global silver supply. Electric vehicles add another layer to the story. Modern cars contain complex electronics and sensor systems. Silver plays a role in many of these components. Power control systems and battery connections rely on its conductivity. So while technology industries expand, they quietly consume more silver. Most people never notice this growing demand. Now here's the problem. Supply is not growing at the same speed. Silver mining faces several structural limitations. Unlike gold, most silver is not mined directly. Much of the world's silver production comes as a byproduct of mining other metals. Copper, zinc, and lead mining produce most global silver supply. This means silver output depends on completely different industries. Mining companies cannot simply increase silver production overnight. Even if silver prices rise sharply, supply growth takes time. New mining expansion can take years to develop. This creates a slow and rigid supply response. And rigid supply eventually creates pressure when demand grows quickly. That pressure may already be showing up in vault withdrawal numbers. When industrial users worry about shortages, they secure metal earlier than usual. Large investors may also move metal into private storage. They see silver as protection against inflation or financial instability. Each of those actions removes silver from the exchange system. And when enough participants do this, available supply shrinks quickly. Banks watch these movements very closely. Futures markets depend heavily on confidence. Traders must believe that if they request delivery, the metal will be available. If confidence weakens, volatility can appear very quickly. This is where talk of a potential silver squeeze begins. Analysts use this term when demand suddenly exceeds supply. A squeeze forces buyers to compete aggressively for limited material. Prices can rise rapidly during these situations. Commodity markets have experienced squeezes many times before. When supply chains tighten unexpectedly, prices move faster than predicted. Silver is particularly sensitive because the market is relatively small. Even modest changes in demand can affect prices significantly. Some analysts also point to geopolitical competition. Countries are racing to expand clean energy and advanced manufacturing. Access to strategic metals becomes more important in this race. Silver sits right in the middle of that competition. Its role in electronics and renewable energy makes it critical. Governments and industries both depend on reliable supply. So when rising demand meets limited mining expansion, pressure builds. Large vault withdrawals only increase that concern. This does not necessarily mean a crisis is guaranteed. Markets can adjust over time. Higher prices encourage exploration and new mining projects. Recycling also increases when metals become more valuable. Technology companies may reduce silver usage in some products. Engineers constantly search for more efficient designs, but adjustments like these take time. Supply shortages can still appear during the transition period. What makes the current situation interesting is how quietly it developed. There was no dramatic announcement or sudden global headline. Instead, the signals appeared slowly in market data. Inventory reports and trading patterns revealed the shift. These subtle signals are exactly what analysts watch. History shows major market moves often start quietly. Long before the public notices, professionals track these changes. Small shifts sometimes signal larger developments ahead. For viewers here on Iron Ledger, this is exactly the type of story worth following. Not because it guarantees a price surge, but because it shows how interconnected modern markets really are. A single metal can link technology, energy, and finance. Silver is a perfect example of this connection. Many people think of coins or jewelry when they hear the word silver, but in reality the metal sits at the center of modern industry. Technology infrastructure quietly depends on it. When something changes in that supply chain, the effects spread widely. Financial markets and industrial production both feel the impact. So the real question isn't just where the missing silver went. The deeper question is what happens next. Will mining production eventually stabilize the supply chain, or will industrial demand keep rising faster than expected? Another possibility is economic slowdown. If global manufacturing weakens, demand could temporarily fall. But if technology growth continues, pressure may increase instead. That uncertainty is exactly why analysts are watching closely. Right now, nobody knows the final outcome, but attention from banks and institutions is increasing. The silver market may be entering a very interesting period, a period where small signals could lead to bigger developments. If current trends continue, the story of disappearing silver could become major news. It could become one of the most important commodity stories of the decade. Before we finish, I would really like to hear your perspective. Do you think the silver market is heading toward a serious shortage, or do you believe the system will balance itself like it has before? Share your thoughts in the comments below. Your ideas often lead to some of the most interesting discussions. Different viewpoints help everyone understand the market better. If you found this breakdown helpful, consider sharing the video. Someone interested in global markets might appreciate it. These conversations become more valuable when more people join them. Awareness helps everyone understand complex financial systems. Thanks for spending a few minutes with Iron Ledger. And stay curious about the hidden forces shaping the world's financial markets.